Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trade in the stock market. And today's episode, we are going to talk about fluid position sizes. Now, this is something that I've not really talked about before in the past. And the reason why I'm talking about it now is it came up in the trading block as a question. And when I was answering, I was thinking to myself, man, this would make a really good conversation for the podcast. And that is approaching the market with fluid position sizes, meaning like, I'll throw this amount of money on this trade and it might be something completely different for another trade. That's fluid position sizes, and that's what I want to talk about here today. So the question that was asked, it was a little bit different than that, but this is the question that spawned this discussion about fluid position sizes. And he was asking me, he's like, Ryan, I am curious about how you handle position sizing. I know you mentioned in the past that you use a 16% of your account on each trade. Curious as to how that is calculated. Do you take into account the stop loss and then size it that way? So what he's asking there is what a lot of people do is that they will, and I don't agree with this approach, but what they do is that they approach the stock market with the idea of like, okay, on each trade, I'm willing to lose up to 1% of my account value if I'm wrong. So if they have a $100,000 account, they're willing to lose $1,000 on that trade. 1%. So if they have a really tight stop loss, that's going to give them the ability to wager a lot more on the stock. So if you have a 1% stop loss, you can go way out there versus if you have a 10% stop loss, yeah, you can still take the trade because in your mind, you're only risking 1% of your account, whether it's a 10% stop loss or a 1% stop loss. But on the 10% stop loss, it's going to be a much smaller amount that you're risking on the trade. The problem with that is, let's say, for instance, you were using a 3-to-1 inverse ETF, and a lot of people use these. I'm not as crazy about them. They really have to be the right circumstance for me to be able to use one. But let's say in this particular case, you have a $100,000 account. You have a trade set up in TQQQ that you really like. That's a 3-to-1 inverse or 3-to-1 ETF. Leveraged ETF of the NASDAQ 100. So if the NASDAQ 100 goes up 1%, you go up 3%. If it goes down 3%, you go down 9%. In this particular situation, you're going into it with a 1% stop loss. That is very hard to do with an inverse ETF, but bear with me for the sake of this example. You go into it with a 1% stop loss. And you're saying to yourself, okay, I'm willing to risk up to 1% of my capital. And let's say, for all intents and purposes, you have 50% of your portfolio on this particular trade because you're able to trade with such a tight stop loss. Well, you hold the stock overnight, or in this case, the ETF, you hold it overnight and it gaps down 3%. Consider this trading environment that we're currently in, where we have seen a lot of gaps to the downside. Very possible. And so you get that gap down of like 3%. Now all of a sudden you're down on TQQQ 9%. So 3% gap down on the NASDAQ, 9% gap down on TQQQ. You have 50% of your position at risk. And I don't even know, I'd have to do the math to determine what the right amount would be. But I guess if you were doing a 1% stop loss, you could do like up to 100% of your portfolio. You put the whole thing on there, right? But in this case, let's say you didn't want to be quite that aggressive. Like you had a cap of about 50% of your portfolio. You have 50% of your portfolio. Instead of being down 1% now, you're down on the trade because it didn't work out. You're down 4.5%. That's where, sizing your position sizes according to the amount that you're risking on the overall trade is dangerous, because you're not accounting for gap downs. You're not accounting for the fact that a stock could be downgraded, or that you could have DeepSeek come out and that position that you have in NVIDIA is now down 15 or 16%. You have to take into account the headline risk. So for me, I don't trade that way. I just go into every trade saying I will risk 16% of my swing trading portfolio on a single trade. So when I'm doing that, my losses will be different in size. So if I have a 3% stop loss on one trade and a 5% stop loss on another trade, it'll be different in terms of the amount that I could possibly lose. But what I also won't be doing is like chasing after a trade that's a 10% stop loss, because that goes beyond what my risk parameters are willing to tolerate in terms of my emotional well-being. I'm not going to, risk 10 or 15% on a trade. So I pretty much standardize the extent of how much or how wide my stop loss is going to be relative to my entry price. That's how I approach it. Now, the fluid position sizes, and I think this is where a lot of people can get themselves into a lot of trouble, is a shoot from the hip mentality. And I don't think that shoot from the hip mentality is ever good, because in this case, what you're doing is you're making a secondary bet on the trade without you even realizing it. You're making a bet on the market of what you think that stock's going to do. And you're introducing, as a result, you always hear me say, don't put variables on into the market that is not necessary. Like, for instance, saying, I need this trade to go up because I need to pay for my mortgage at the end of the month. That's injecting a variable that has nothing to do with stock trading. And in this case, you're also injecting a variable when you're shooting from the hip and using fluid position sizes, because you're saying, hey, I think this stock is going to go up pretty good. I'm going to put a little bit more against this trade. Instead of 16%, I'm going to put 25% on this trade. Or you may not have as much confidence on the trade and say, this is a little bit of a crazy stock. I'm going to just put it like 5% at this one. I'm just going to throw 5% at it. And as a result, you end up getting these like secondary variables that you're injecting into the market doesn't care about. But you're making a bet outside of the fact of whether or not you think it's a good trade setup to begin with. And if you think it's a really good trade setup, you're putting more money on there. If you think it's a bad trade setup, you're putting less money on there. Now, the question is, well, it sounds good on the surface, right? It's like, oh yeah, put your money where you're most confident in. Put the least amount of money in the trade setups that you're the least confident in. Well, why would you even take a trade setup that you're not necessarily liking, or you think that it's a high risk? Why put any capital at risk at that point? Only go after really good trade setups. And so for me, standardizing the amount that I'm risking on every trade, whether I'm trading JPM or whether I'm trading SSO or whether I'm shorting the market or whether I'm going long on the market, needs to be the same. Because by doing so, I'm not injecting another variable on the market. I'm not shooting from the hip saying, this is what I think that the stock's going to do. Because I can tell you from experience, the best trade setups that I've ever been a part of are oftentimes the ones that I was like a little bit nervous in. I was like, oh man, I hope I'm making the right decision here. Yeah, the charts might look really good, but I knew that there was, you get these impressions about stocks. You might lose 3 times in a row on a stock, like it could be any stock. It could be Meta, right? META. You've lost the last 3 times you trade a Meta. It's like, oh man, this is a great trade setup, but I have no confidence in this one. And then you end up blowing the roof off of that one. You go up 25% on it. You're like, man, I'm glad I didn't, listen to myself about that one. I'm glad I didn't put less amount on it than what I would normally put. And that's what I mean by fluid position sizes. You're just shooting from the hip. You're letting emotions dictate. And that's largely what will dictate whether or not you have a big position size or a small position size, is the emotions that you feel around that stock. Oftentimes it has nothing to do with the chart itself. It has everything to do with the emotions surrounding the stock. So there's stocks for me that I just won't trade. They're on my do not trade list, because I don't trust the stock from a headline risk standpoint. One perfect example is Boeing. BA is one of the craziest stocks from a headline risk standpoint. I won't trade it. And I can only imagine if I did not have that do not trade list and BA was fair game for me to trade, that I would probably say, I'm going to put, 1% of my capital on that trade. And then if it actually did work out, I'd be shooting myself, because I'm like, why did I not put more on that money? I was so stupid. That's what you want to avoid, because then what do you think is going to happen the next time BA shows up into your scans? You're going to be like, okay, I'm going to make up for that last trade where I didn't put much down. I'm going to go way overboard. I'm going to go 30% on this trade, and I'm going to try to make some of that money back that I should have made on the last one. And then that stock gets a downgrade, or something horrendous happens that causes the stock to go down, and all of a sudden you've just lost 10% on that trade, and you were showing too big of a position size. Why? Because you let the emotions come into that trading decision. You allowed to have fluid position sizes based on that feeling, based on that shoot from the hip mentality, gut feeling, whatever you want to call it. That's what was driving it. You were letting variables be introduced into the market that shouldn't have been there. What should be there is you subscribing to swingtradingthestockmarket.com. You go to shareplanner.com, you can see all of my different options that I have, different training courses. You can sign up for different services. I have some really good stuff that I offer there. You can go there. When you go to swingtradingthestockmarket.com, that will take you to my Share Planner website. So there you can support this podcast by signing up for one of those services. Really good. One of them, of which really cheap and affordable, is the Swing Trading the Stock Market service that provides you with all of my stock market research each and every day. That's going to include stock market updates on the mega caps, plus a daily watch list of stocks that I'm looking to trade each day, plus a master bullish and bearish list of stocks that I'll curate those setups from by going to swingtradingthestockmarket.com. So check that out. You're supporting the podcast in the process. One of the things, too, that not having fluid position sizes will keep you from doing, it'll keep you from trading trash. There's a lot of trash you can trade out there. A lot of people get caught up in some of these EV stocks. There's a lot of stocks like Rivian and NIO, and I might have lost some of you guys just by mentioning those stocks in the same sentence as trash. But it's not so much that the companies won't eventually make it, but when I call something like trash stocks, they can often mean like highly volatile, highly unpredictable stocks. Maybe one day they come around and they do really good. But one of the things that my trading strategy won't let me do is trade those, because one, I don't trade stocks under $10 a share. NIO is below that threshold, so I don't have to worry about that one. Rivian is right at the threshold. So, but I won't trade them just because they're so volatile. Trying to get a good stop loss can be next to impossible to do. So for instance, if I was to trade Rivian, which is slightly above $10 a share at the moment, I would be getting into a stop loss probably, if I'm just guessing here, probably like 10-15%. So then I need about a 30% return to even justify that risk that I'm taking on. But with a 16% position size, you're starting to get into some crazy risk there, something that goes a little bit beyond. Now, fluid position size, like, yeah, let's throw some money at it, right? Let's throw, maybe 3% of my capital at it. Yeah, but then you're injecting emotions, you're injecting variables into the market that the market doesn't care about, that doesn't help you long term. So I keep my position sizes the same. I don't engage in fluid position sizes at all. And it keeps the emotions the same. Every trade is just as serious as the other one. The one thing I don't want to do is like, it's only a 3% position size, I'm not too worried about it. That's always a bad thing, because if you're not taking your trades serious because they're not big enough, then you're not managing the risk. You're going to likely let that stop loss on that trade slip if you're even using a stop loss to begin with. You're not going to be passionate about that trade in the sense that you're going to see it through from cradle to grave. With all my trades, they're all the same position sizes, so I'm taking every single one of them extremely, extremely serious. I'm going to manage the profits. I'm going to manage the risk when the trade goes against me. I'm not going to show, little interest in the trade, like, it's not a big deal. Now, there is a time where, as I'm taking profits, that position size does shrink. And in doing so, that's because I have taken profits along the way. That's a good place to be in. That's where I have a lot of profits. I'm moving up the stop loss. I'm letting that final third or final quarter of a position run as long as it can before I eventually close out the trade. So remember, like the worst trades sometimes, or the ones that I have the least amount of confidence in, they turn into a lot of times my best trades. And if I'm putting the least amount of money in those, that's a problem, because then that would suggest too that some of my trade setups that I'm the most confident in, the ones that I am most excited about, they oftentimes turn out to be some of the worst trades that I make. The ones that are like, man, that one did not go the way I expected. That one just went straight down and took out my stop loss right away. But then if I'm using fluid stop losses, it would suggest that I'm putting the most money into the trades that I'm most excited about, and the least amount of money in some of the trades that I'm most worried about, but they become the most successful. And you don't want that to take place in your trading. You're projecting how successful you're going to be on a trade without actually knowing with any confidence how successful you're going to be on a trade. Every trade that I go into, I talk about how some I'm like not sure of at times, and not because I think that sketchy setups, but because I might have a preconceived notion about it. It might be like, holy cow, I've traded, Apple the last 3 times and I've turned up negative each time. That doesn't mean that the 4th time is going to be negative. It just means the previous 3 times. So I might have a lower level of confidence just from an experience standpoint. But what I don't want to do is project how successful that 4th time is going to be without actually knowing, or by bringing down the amount that I'm investing in the trade. I don't want to do that. So I keep my trade sizes standardized. I keep them all the same. So wrapping it up here, what have we learned? Fluid position size is not bad because you're shooting from the hip. It's kind of a gut feeling mentality. And oftentimes what you should be putting into it, that trade, is not the correct amount. You're injecting a variable into the market that the market doesn't care about. So we want to stay away from that way of thinking. Also, standard position size is not basing it off the amount of the stop loss. And I've done a number of podcasts on that, or podcast episodes on that recently. So go back and check some of that as well if you want to know more about my opinion on those questions. But I don't base my amount or my position size based on how wide or how tight the stop loss is. I keep it standardized across the board. If you enjoyed this podcast episode, I would encourage you to leave me a 5-star review on whatever platform that you're listening to me on, whether it be Spotify or Apple or there's tons of them out there. I don't even know how many of them are out there now, but whatever platform you're listening to me on, do me a huge, tremendous favor. It means the world to me. Just leave a 5-star review. I would greatly appreciate that. Also, if you're listening to me on or watching, I guess, in that case, on YouTube, make sure to like and subscribe. Tell me down in the comments below, what are your thoughts on this episode? How do you approach your position sizes? Is it standard? Is it fluid? Or is it based off of the stop loss? I'd love to hear your approach, your take. Maybe you got a different way of doing it that I've never even heard before. So let me know about that. And make sure to check out swingtradingthestockmarket.com. And make sure to send me your questions, Ryan@sharepointer.com. I do read them. I love hearing from you guys. Let me know what you guys are struggling with, the problems that you're having in your trading. I want to hear about them. Thank you guys, and God bless.